This is your market update for Thursday, June 29th, and we had a couple of key economic reports come out earlier today that showed figures that were better than what the market had anticipated. The first being the initial jobless claims report for last week, which is the report that shows unemployment claims filed for the first time, came in reflecting a number for claims that were less than what the market had anticipated and less than the previous two reports reflected. So that could potentially support continued strength in the labor market, although I do believe those numbers are skewed a bit for one reason being the Juneteenth holiday. In addition, we had the GDP reading, the final GDP reading, which is the gross domestic product reading for Q1 of this year, which showed a number that was a good bit higher than the previous two readings. And that is the final reading, so basically shows continued strength in the economy and growth in the economy that was better than what the market was expecting. So as you can imagine, you've got two reports that came out that were better than the market anticipated and could potentially support the Federal Reserve's reasoning for at least two more rate hikes moving forward. Bond market did not like that. Mortgage-backed securities opened the day down 55 basis points, have continued to sell off a little bit, are currently down 67 basis points. So mortgage pricing today is certainly worse than it was yesterday and you know what it's been over the last couple of days, really. The stock market, of course, likes favorable economic information and as a result has rallied on the day for the most part. The Dow is currently up 239 points and the S&P 500 is up 13 points. NASDAQ is actually down 16 points. It is more rate sensitive, so it is not digging on the news that came out today that would support higher Fed funds rate hikes or higher Fed funds rates moving forward. Freddie Mac did publish their 30 and 15-year rates today. They did show an uptick in rates this week over last week. Not much, but a little bit. The 30-year increased by 0.04% and nationally is currently sitting at 6.71%. 15-year ticked up by 0.03% and is currently sitting at 6.06%. We have the PCE report tomorrow that comes out, Personal Consumer Expenditures Report, which is a key measure of inflation that the Federal Reserve will look at very strongly moving forward. As I've mentioned before a million times, let's hope for a favorable inflation figures tomorrow. It would be nice to gain back a lot of what we've lost today in the bond market. So we will keep our fingers crossed on that, say a little prayer. I hope you guys have a great afternoon and I will see you tomorrow morning.